Yeah, we can.
Yeah,
I can hear you.
you. I also hear a lot of Russian going on there.
Well, we're trying to rush the meeting.
I think the participant was not muted and they are now muted.
Yes.
Okay, all right.
All right, so introduce yourself, please, Stephanie.
Stephanie Dinberg for Commissioner Caban.
All right.
John Dorset, designee for control of rattling.
Steve Meyer, invited participant and CIO for Bureau of Asset Management.
Kevin Lee, Mayor's Office.
Nadia Fadlina for Commissioner Neeblock.
Author in the PBA.
Chris McGrath, PBA by invitation.
Frederick Winter, PBI.
Marie Furley, PBA by invitation.
Roman Cadifila from Wilshire, present by invitation of the trustees.
Rob Appling, Wilshire, present by invitation of trustees.
Anthony Brody, SBA.
Jeffrey Ward, DEA.
John Beatty, LBA.
Chris Monahan, CEA. Bob Senskestead, Pension Fund, present by invitation.
Nicole Jambrisi, Police Pension Fund, present by invitation.
Also present on.
Timothy Gifford, Police Pension Fund, present by invitation.
Ralph Mondial, Police Pension Fund, present by invitation.
Mariana Deligari, present by invitation.
Okay, I think that, does it. What's that, John?
I would just note that there are several members of the Bureau of Asset Management that are joining remotely, and in the event that they speak, they will identify themselves. However, I do not believe that these will have any comments or anything. So with that, I'd like to turn it over to Steve Meyer to walk us through a very brief quarterly update, and then we will go into executive session to discuss specific manager.
Terrific. Thank you, Ken. And good afternoon, trustees. So I actually got up early this morning. I was in the office at 7, honing my notes to get it down to 20 minutes. But given the time constraints, I'll certainly rush through. I know we've got Kate going to flip slides. I'll just give you a quick 5-minute update in terms of what's going on in the world and what's going on in the market, and more importantly, the performance of your fund through fiscal year end 2024. On the next slide, Kate. I think it's fair to say that the inflation dragon has been slain both here and abroad. We see inflation coming down significantly. On the next page, just a quick look, you can see inflation measured by CPI and core PCE deflator, both under 3%, certainly positive, and welcome news to, the U.S. economy and for the Fed. On the next slide, just look at those 3 big markets, the U.S., the Eurozone, and the U.K. All of them have seen inflation trend down materially since the peak of 2022, 2023. And you can see in red there that our inflation level, again, below 3% at this point. It's even lower in the Eurozone and the U.K., so a good outcome there. And rates are starting to come down, and both the Bank of England and the ECB have already cut rates, with more to come. On the next slide, there is a question if the Fed is behind the curve in terms of whether it should have cut rates earlier. And concerns are mounting around the unemployment rate, which I'll talk about in a moment. More importantly, though, we had a Jackson Hole Central Bank Symposium in August. It's an annual event. It's a big deal if you follow central bankers. And there, Fed Chair Powell spoke at it. It's referred to as a pivot, where he's actually reflected, and I'll give you some quotes. The time has come for policy to adjust. He also stated that inflation has declined significantly, that the labor market is no longer overheated, and with appropriate dialing back of policy restraints, a 2% inflation level and strong labor markets are both achievable. So it's a pivot away from concerns about inflation. I think they're saying that they've made great success, that will continue to trend down, and now focus on the unemployment rate. On the next slide, we can see a slight uptick on the far right-hand side. Unemployment in July was up to 4.3%. In August, it actually ticked down to 4.2%. We had the non-farm payroll report last Friday, which was really kind of a mixed bag. They were expecting to see 165,000 jobs created. Actually, only 142,000 were created. But again, because the unemployment rate ticked down, the market is still uncertain as to how much the Fed will cut rates next week on the 18th, whether it's a 25 or a 50 basis point cut. I actually think, depending upon what we see for CPI tomorrow, it's more likely to be a 25% rate cut, 25 basis point rate cut. On the next slide, also economic activity, both in the U.S. and Eurozone and the U.K. are slowing. We actually saw 3.1% GDP growth in the second quarter, year over year. That's versus just 2.9% in the first quarter. and it's expected to slow to the mid to low 2s, in the second half of this calendar year. On the next slide, just a familiar slide, you can see, again, the disruption associated with the pandemic in 2020 and following. But you can see on the far right-hand side, again, the most recent prints through June, the economic growth has actually trended down pretty significantly in the Eurozone, about flat, UK about flat, again, US 2%, and in China in green about 4 to 5%. So again, a normalization in global growth there as well. On the next slide, rate cuts are coming, as I said. The question is when and by how much. Fed's pretty clear in terms of telegraphing their intent to reduce rates next Wednesday, the 18th. Probably, as I said, 25 basis points. We've already seen rate cuts by the European Central Bank, the Bank of England, the Bank of Canada, and others. On the next slide, again, it has changed since we last met in July. And you can see that Fed funds are steady at 5.5%, but official rates have started to trend down. You can see the slight adjustment downward in yellow for the Bank of England, a slight adjustment downward for the European Central Bank in green. The outlier here is actually the Bank of Japan in purple, where they've actually raised rates coming off of a negative interest rate, and then they have a positive 25 basis point rate. That had to contribute to some level of volatility in the market in early August associated with the unwinding of the yen carry trade, which I'll talk about in a moment. Let's skip the next slide, Kate. Let's skip the, well, actually, this slide's interesting. We've actually gone away from having an inverted yield curve. An inverted yield curve is a fancy way of saying that very short rates are higher than long rates. And typically, when you invest out, say, 10 years, you expect to pick up a maturity premium, meaning a risk premium where the return is higher than you get on a short term. And you can see that blue bar on the bottom, that's a normally shaped yield curve. Again, short rates are lower, long rates are higher. In gray is a flat yield curve, and what we've been dealing with the last 2 years, the longest in history, is an inverted yield curve in the States, reflected in both red and orange, and that's actually changing now. On the next slide, just to look at 2-year and 10-year yields. Last week, they were both at 378, which means flat yield curve. There's no inversion, and we now have a positive slope yield curve. On the next slide, just to look at that and to get a sense for how significant the yield curve inversion was at its peak. It was 110 basis points in March of 23, and again, the longest inversion in the history of our markets. Next slide, just a quick look at spreads. High yield in orange, again, 316 basis points over those U.S. Treasury rates. Interesting, but not necessarily compelling. We like it better if it's 400 or 500 over. And investment grade in white at about 100 basis points over the curve. Again, I think that's relative fair value. Next slide, just a quick look at what happened in the summer. Summer vacation is over. We got back to work last week. On Tuesday, the 3rd of September, global stocks, U.S. stocks sold up 3%, bonds rallied, yields moved lower, and in one day we had oil trade off fully 8% on concerns about demand out of China in particular. On the next slide, I'll look at benchmark returns for the second quarter of 2024. Really what I focus on here is looking at the middle, the 1 year, that's the fiscal year 2024 full year results. And you can see the benchmark, the Russell 3000, is a broad measure of U.S. equities, small, mid, and large cap, was up fully 23%. The other interesting thing is if you look at the far right-hand side and take in perspective that 23% return in 1 year for U.S. equities, the average expected annual return, the average of our 5 general consultants for the 5 different New York City pension plans, is just 6.7%. So that 23% is not likely to be repeated soon. It's certainly not to be counted on, relied on. But again, it was a good outcome that certainly helped power the performance, which I'll talk about in a moment. Okay, let's skip the next 2 slides and just look at where market returns are. I'd say the takeaway here is you can see that obviously we've had positive returns generally in equities. More importantly, on the right-hand side, the blue bar above the black line is a 0% return. Usually fixed income delivers a positive return. The exception was, again, 2022 and 2023 with that backup in base rates, which will now help the portfolio because you've got more yield associated with your fixed income investments. Next slide, recent news. I mentioned the August 5th sell-off. August 5th sell-off was pretty significant. There's a lot of volatility. The measures of short-term volatility, the VIX, picked up to its single largest increase up to 65 in one day, single largest jump in history. But on the next slide, you can see that that's just the month of August. On the next slide, Kate, you can see that we ended up in positive territory for the S&P 500, the Dow Industrials, and the NASDAQ, irrespective of that sell-off that occurred early in the month. So a lot of volatility associated with an unwinding of the yen trade. Again, a fancy way of saying people were borrowing at zero interest rate in Japan, in yen, and then buying other currencies and investing in risk products to generate a return. And as those rates start to move higher in yen, those trades were unwound, which caused a lot of volatility. Let's skip the next slide. Food for thought, and this is something that I keep coming back to. So I don't mean to sound overly alarmist, but I do think at some point that the U.S. is going to have to wrestle with its level of debt outstanding. And just read some of these headlines. So right now, our debt level relative to GDP, our outstanding debt level to GDP is about 97, 98%. It's trending higher. And one thing we do know with some level of certainty is, irrespective of who the next president is, both parties and both presidential candidates reflect an interest to continue spending at the rate we've been spending at. Again, running $1 trillion or more in deficits a year for the next 10 years. We now have $9 trillion in government debt maturing over the next 12 months, so there's lots of new recycled supply coming. Household pensions and insurance companies have been buying more treasuries, and it's a good thing because China has actually lowered, and several of the other non-U.S. buyers have lowered their holdings of treasuries. In this case, China went from $1.2 trillion down to just $800 billion today. The other interesting issue is that debt outstanding in T-bills is currently about 22%. It's about double what it is traditionally, and that's really to fuel the demand associated with people keeping money in money market funds. And again, the primary investment there is in T-bills. On point 9, debt servicing currently is about 12% of government outlets. We're paying over $1 trillion a year just to service our debt outstanding. And that amounts to about $3 billion in interest expense payments a day. So again, very significant. And on the last point, the bottom point, again, this is one of Apollo's slides. What should we be watching? We should watch the treasury auctions. We watch for either the potential for failed auctions or fat tails where the auctions don't go well, that there's not really enough demand to meet supply at its price. Rating agencies, S&P and Fitch currently have the U.S. debt rated as AA+. Moody's is still a AAA. There might be a downgrade there at some point. And the last point, which is very important, term premia. That's the additional amount of yield you get paid for going out further and buying U.S. debt further out the curve. And again, as that widens, we think that will help power the performance of the portfolio by providing a higher base rate and a higher level of income for your portfolio. Let me skip ahead a couple slides, Kate. Make it 4, maybe 5. On slide 29, Kate, maybe one or two more, please. Yeah, this is interesting. We talk about data centers, and Petra will come in, and Blair will come in and talk about our investment in infrastructure. And again, a big component of that is data centers that actually support both cloud, but more importantly, artificial intelligence processing. Here in the U.S., on the far of that big bar, you can see that we have over 5,000 data centers that are in operation today in our country. And you look at that relative to the rest of the world, again, it may be a size differential, that may be part of it, but what this raises in my mind is, do we have too much investment in data centers in the U.S.? My answer would probably be no, but it's probably an interesting investment opportunity for non-U.S. investments in infrastructure and debt. We have a little bit of exposure to data centers as well in private equity. Let's skip the next, John, how many, 2, 3, what's one? Maybe go to slide 32, Kate. So this is interesting. Again, just food for thought in terms of some of the changes we're seeing. We talked about demographic changes and retirements and aging population. Also, a declining population. China's population growth is now negative. It's negative 2.5%. The fertility rate in China is just 1 versus the US at 1.6 and Japan at just 1.2. The working age population is currently about 1 billion in China, and it's expected to decline roughly 100 million people every decade going forward. The population of China is supposed to move from around 1.2 billion people to about 660 million by the end of 2100. And the answer that they perhaps have to this issue is robotics. Again, replacing human labor with automated robotics. And I guess the last point that might be of interest, just to read it, is that 30 million more men than women exist in China. So there's probably a shortage of women of childbearing age as well. And on the next slide, just a quick look. You can see how the birth rate the population growth rate has declined pretty significantly since the late 1990s, and again, now it's negative 2.5% in China. Let's skip ahead to 36. Speaking about China, they are, however, the leader in wind and solar projects around the world. If you read the top line, there are more wind and solar projects under construction in China today than the rest of the world combined, which is significant. So again, embracing sustainable forms of energy. They're still developing a number of coal plants, so they're taking out of one pocket and putting it into the other, unfortunately. But again, just an interesting development there. Why don't we skip all the way ahead, Kate, to performance, and I'll be brief. But the news is good on that slide. Thank you. The takeaway here is the top line: police total plan. Your total plan for fiscal year 2024 under the 1-year sector with a 10.2% return. Again, that's off of your actually assumed rate of return target of just 7%. So that's a really good outcome. And kudos to the trustees consistently over time for making good decisions that help drive that performance. And it's really great. It's really nice to see that there's all green on the screen. Your performance relative to your policy return, if you're at your strategic asset allocation weight, obviously we've underperformed that because it takes time to ramp up your private assets. Tough median, that's Wilshire, that's a Wilshire product. It stands for Trust Universe Comparison. And Rob, correct me if I'm wrong, but I believe that universe typically is a little smaller, maybe with a slightly higher allocation to private assets is what I'm told. It could be a driver of the differential.
It just depends on how you carve it up by size, really.
Okay.
Yep.
Yeah, I don't know. Yeah, this is just a median indicator, but still we're slightly above that, again, in the 1-year space. Again, most importantly, you want to look at return performance, 10 years, 15 years, 20 years. We have 5 years here. Again, total police plan, 7.9%, outperforming that 7% target. That's a great outcome. Next slide, just a different way of looking at it. If you generate a 7% return, if you invested $1,000, generated a 7% return over the last 10 years, where you'd be, the blue line, that's the blue police line. Above that green line, which is the 7% target, you're in a surplus position today. Next slide, just to look at police's net public market returns. Again, focusing, you can look at the fourth quarter of fiscal year 2024. You look in 1 year, your equity performance, you've delivered 22.3% returns, world equity, ex-US 8.1%, emerging markets 14%, high yield 10%, and cash 6%. Again, you have a very small allocation of cash, but a good outcome there. Your net returns in basis points, your excess returns, again, on the next slide, Kate. Sorry. Yeah, you can see that obviously we've struggled a little bit in equities because of concentration issues around the benchmarks and active strategies underperforming the passive strategies pretty consistently over time. We hope that will change at some point. On the next slide, we put together a slide. I won't dwell on this, but we're trying to present your performance in ways that are a little different. You can see in the public market sector, that pie chart on the left, you've got about $38 billion in public market assets, and on the far right-hand side, what you want to see here is the darker lines, the darker blue exceeding the lighter blue. The darker red, those are for 3 months, 1 year, 3 year, and 5 year. The darker the better, the higher the better. But you can process it over time. Next slide, a quick look at fees. again, your fees for public market performance or asset management for the second quarter of 2024, calendar year, was about $13.5 million. That's it equates to annualized about $54 million in fees a year just for public markets, and a breakdown on the right-hand side. So the takeaway there is all strategies combined in public market space, about 15 basis points. We believe that we should be putting more information in front of the trustees in terms of demonstrating exactly where you're paying, what you're getting for the value you're getting for the fees, the alpha that's generated. And again, we should be able to demonstrate and prove that over time, we're systematically negotiating those fees lower. We are, but we need to do a better job presenting that to you trustees. On the next slide, again, police's net private assets, not public, for the most part, all green. In 1 year, under real estate, private real estate, that's a combination of core and non-core. Office space has still struggled a little bit. And again, that asset class delivered a negative return of 6.9%. But again, everything else is pretty healthy. I should also recognize that hedge funds delivered a 6.7% net return through the end of June, which is a really good outcome for your portfolio. Infrastructure, 10.5%. Alternative credit, again, with higher yields and wider spreads, and spreads now tightening, over 12%. So good outcomes across the board. Kate, maybe skip ahead one slide to the charts. Yeah, that slide. So this, again, this is a look at your private assets under management, and what the breakdown is. You've got about $16 billion in assets in the ground, including, again, hedge funds and private assets. The takeaway here is on the far right-hand side, what you're looking to see is the darker lines should be higher than the lighter lines. And that is the case for private real estate, even though you have a loss, the dark blue line in the 1 year sector, a lower loss was actually a benefit. But in private real estate, infrastructure, and Petya and Blair have done a fantastic job, and team, it's steady Eddie. It consistently outperforms its benchmark by a nice spread, and alternative credit has always outperformed its benchmark as well, with a varying degree of volatility. Maybe last slide, and then I'll call it quits, so I can feel John's energy next to me. Just a look at the money you have in the ground, what you've actually reviewed, committed to relative to what's under management. So the slides are basically in far left-hand side, private equity. Your assets under management right now, we have in the ground and generating a return, $5.6 billion. What you've already committed to, but has not yet been called, is called unfunded, a little over $3 billion. You can read that across the way. You can see that there's a little bit more work for Anash and Petya and John and Tina to do in their teams in terms of well, these are deals that are approved, but even that, there's an under allocation, which I'll show in a slide in the executive session, that reflects there's more work to do, there's more deals to review and approve in that space. Okay, I know we threw a lot at you. Sorry, John, I went over the 5 minutes, but are there any questions or anything I didn't cover?
We'll take it from the back end. Any questions for Steve? Just a reminder, Steve's team always available to answer questions, and even go into more depth. I will take that opportunity to just remind everybody that BAM University this year is on the 27th and the 30th of September, so we encourage all trustees to participate and to come. We're doing it on the 10th floor of the municipal building. So you'll see an invite, and that's trustees only. And we hope to have a very good conversation about the investment world and a place to ask questions and understand a little bit more about it. So just to remind you. With that, I'm going to make a motion to exit a public session, enter into executive session to discuss specific matters.
Second, CEA.
The course of ayes. All right, we're all in favor. So, yeah, we've got to say recording. Camera, oh, the camera is recording. Okay, thank you very much. So,
And away we go, John. So, the trustees heard presentations from the BAM staff and from several investment managers, the results of which will be revealed at the appropriate time.
So with that, I'd like to make a motion to adjourn.
Second.
Thank you. We are adjourned, and I just want to say, from behalf of the Controller's Office, our thoughts are with the men and women of the NYPD and the other uniformed services on the anniversary of September 11th. And we don't take that lightly. I just wanted to say that before we.
If you can.
Thank you.
Thank you.